All right. Hello, everyone. Welcome to the day 4 of the TX revision session. And basically, we started discussing section A and B type questions in previous session. And we also discussed 2 to 3 other areas. For example, we talked about the large companies and the installments. We also discussed at time of starting a business, individual person should think with respect to 2 dimensions for deciding the accounting and date. What are these dimensions? One of them is impacting the overlapping months and overlapping profits, and other dimension impacting the timing of tax payment. Thereafter, we started practicing questions, and basically we attempted a few questions in last class, and now I'm going to continue from the same, and our strategy will remain the same as we are practicing questions, and I'm giving you time to solve every question. Then I will discuss. So the strategy will remain same for today's session as well. We have 45 questions to solve, and from 45 questions, 5 done in previous session. And now continuing from the question number 6, I will be showing my slide in front of you and would be giving you appropriate time to solve that question at your own. We'll ask the answer. You may write in the chat box, and then I will start my discussion. So try to solve these questions in exam conditions. By the way, for a 2 marks question, normally we have 3 point, for 1 mark, we have 1.8 minutes. If a question is for 2 marks, you may simply multiply 1.8 into 2. So around it's 3 minutes time to solve every question. But as we are practicing now, so I would be giving you a lesser time, let's say max 2 minutes to solve these questions. And after 2 minutes, I will start my discussion. So I'm moving towards the next question, which is question 6. Read it very carefully. Read the requirement first, then read the scenario by keeping the requirement in mind, and do solve your question. Good luck. I always appreciate if you participate in the session, as few students have started sharing their answers. So all of you are requested to please share your answers as well. You are doing right or wrong, that is a secondary discussion. The primary discussion is that you are basically trying to solve, and if you are trying, so I would appreciate if you share your answer. Thank you. Okay, all right. So few of you have shared the answer, and all of you are like telling D is correct answer. But your choice is wrong. D is incorrect. Revisit your answer, revisit your choice. Maybe you come to the correct point. Then again, I'm not discussing right now. I'm giving you further 1 minute time to think appropriately and try to select the best option. Although D is not correct. Now I can see, Daniel, now your choice is fine. Yes, Umar, yes, there is a deduction which you're not recalling. Okay, don't worry. Let me discuss this one. This question is pertaining to the capital gain taxes of individual person. What amount of unused capital losses will SOM carry forward for the to the tax year 22-23? Read it again. What amount of unused capital losses will S carry forward to the tax year 22-23? Okay. Requirement is to basically to check the amount of unused capital losses which can be taken to this year. For the tax year 21-22, the S has chargeable gains of 23,900. She has unused losses of 21,600 from the previous tax year. So you can see is that here it's a remaining loss of 26,100. From the remaining loss amount, this loss can be carried forward and can be adjusted against future capital gains of individual person, and the remaining loss can be deducted from here. So basically the value which can be deducted, the loss which can be deducted from 22-23, which can be carried forward to this year. So basically that's a requirement. And one more thing, in individual person capital taxes, every individual person gets annual exemption of 12,300. And at time of adjusting any losses, we always try to preserve the annual exemption amount. After deducting X amount of losses, the differential should be equal to 12,300, because we always want to preserve this annual exemption. We do not want to waste this annual exemption. So from 26,100, how much losses can be deducted? So these losses are as balancing figure can be deducted as 11,600. So then the differential will be equal to annual exemption. Then finally we will be deducting the annual exemption this year, and chargeable gains for this year will become nil. Taxable gains will become nil. But the question is not about 2021-22 taxable gains. The question is to tell the amount of unused capital losses that can be carried forward to this year. So basically, according Is my voice clear? Can you please confirm? Hello.
Yes, confirm.
Okay. So basically, we are discussing that.
This meeting is being recorded.
So basically, we are discussing that at time of adjusting the capital losses from the capital gains, every individual person should think about preserving annual exemption. Preserving annual exemption means the losses can be deducted in a manner as balancing figure, so resulting amount will be equal to the annual exemption, so this annual exemption can be used and not wasted. So it means from 26,100, if the person has adjusted the losses amount in 2021-22 to the extent of 11,600, so what is the remaining loss amount which can be carried forward to next year? So that is basically 14,500. C is the correct answer. Everyone, please confirm, is this thing clear? I guess now you are able to recall the relevant concept. And now I guess you have. What about you? What about others, please? Because all of you marked the wrong answer. Okay, good enough. So how much or what amount of unused loss can be carried forward to the next year? So that is basically 14,500. C is the correct option. Moving forward, your time starts now. Be quick, my dears, be quick. Try to attempt at earliest possible in exam conditions. Make sure you are not using your cell phone while attempting these questions. What's your answers, please? All right. A requirement is to simply calculate A's capital gain tax liability is capital gain tax liability for this fiscal year? It's not A limited. So basically this question is about individual person. If it is, let's say, A limited, then it's pertaining to a company, but now the question is for an individual person. For the tax year 21-22, A's taxable income is 34040. Why this taxable income is given in question? Keep remember, if anything is given in question, so that has a reason. Nothing is given without any reason for deciding the capital gain tax rates. By the way, what are capital gain tax rates? CGT rates are 10%, 20%, 18% or 20%, sorry, 28%. But these are pertaining to the residential property disposals. And these rates are pertaining to other asset disposals. And when we do apply 18, 10 or 18 means the lower rates, and when we do apply the high rates, so basically these are dependent upon the status of taxpayer. If a person is a basic rate taxpayer in the income taxes, so capital gain tax is applicable at a lower rate. But if a person is paying tax in the income taxes at 40% or 45%, means he is high or additional rate taxpayer in the income taxes, then that person would be paying capital gain taxes at a high rate, which are 20 or 28%. So hopefully you have recalled the relevant area. The basic rate band limit is 37,700. How we do cover this band limit? Firstly, it will be covered by taxable income and then by any gains amount. Taxable income in question is given as 34040. It means which amount is left in the basic rate band. So that is only to the extent of 3660. During the year, he sold an antique watch and the resulted chargeable gain of 33,900. These are chargeable gains. These are chargeable gains. From the chargeable gains, every person gets annual exemption of 12,300. So basically the taxable gains are becoming 21,600. From the 21,600 to the extent of 3660, these gains are falling into the basic rate band limit. To this extent, capital gain tax will be 10%, and the differential of 17940 is gonna tax at high rate of CGT, which is 20%. So it's being calculated as 366, and if you do multiply 17940, and if we, let me check, 17940 into 0.2, so that's giving you 3588. And the total tax liability is calculated as 3954. 3954, option A is correct answer. What about you guys? What you selected? Is this thing clear? Please do let me know whether you are okay with the things. So then we can move forward. In case of any query question, even you can unmute and you can ask your question. These are chargeable gains, Umar. From the chargeable gains, we always deduct the annual exemption to arrive at taxable gains. Then from the taxable gains, to this extent, these gains are falling in the basic rate band limit, and the excess gains, on the excess gains rate will be high rate, and the gains which are falling in the basic rate band, to that extent, capital gain tax will be applied at a basic rate of 10%. Okay, good enough. Moving forward, a requirement is to calculate delimited's chargeable gains in respect of the disposal of the factory. It's the chargeable gain of the company now. Let me recall the relevant pro forma for solving the chargeable gains for a company. We do take the disposal proceed. From the disposal proceed, we should deduct the index cost. How we do calculate the index cost? So in the cost, we also do add the indexation allowance. The sum of these two will become the indexed cost. When the indexation allowance is added to cost, so the cost becomes index cost, and then index cost is deducted. Then index cost is deducted from the disposal proceed, and finally we do get the chargeable gains of the company. D Limited sold the factory on 7th Feb 22 for 260,000. So disposal proceed is 260,000. This factory was purchased on 4th July 1997 for 114,000. So basically it is 114,000 is the cost. If an asset is purchased before 31st December 17, if an asset purchased before 31st December 17, or if an improvement or capital expenditure incurred before this date, then for such asset, we do also take the indexation allowance. Indexation allowance calculation is based on a different formula, but normally you can see in your kit questions and also in this question, the index factor is directly given as 0.766. Indexation allowance is calculated as index factor multiplied with the cost incurred. Index factor is always, you will see the index factor to 3 decimal places, and the cost incurred is 114,000. So 0.766 into 114,000, that is basically giving you as 87324. Adding the cost and indexation allowance, so the total index cost is calculated as 201,324. And this index cost is deducted from the disposal proceed, and the chargeable gains for the company is basically calculated 58676. So D is correct option. How did you calculate it, Ikra? Guys, I guess you have made some mistake. Are you guys clear with this thing? All right. I can tell you the next question is pertaining to the matching principle. So let me recall few relevant points with respect to matching principle. Matching principle is a concept in the capital gain taxes for both for individuals and for companies. There is a common concept named as matching principle. Matching principle is used for the calculation of the cost of shares. I repeat, matching principle is used for the calculation of the cost of shares. For individual person, matching principle is basically has 3 steps. For companies, matching principle has 3 steps. But for individual and for companies, matching principle has 3 steps, but the second step is somehow different in between these two. Let me tell you the match. I would be erasing all these things. Matching principle for individual persons and matching principle for companies. Matching principle concept is used to fund the cost of shares. Same at time of disposing shares by a company, what is the cost of share? In the matching principle for individual, first of all, we do consider the same day purchases. Same day means the day when the assets are disposed, do consider if any assets purchased on the same day. For individual, we then consider on second step next 30 days purchases, and remaining shares we do consider from the shares pool. For companies matching principle, the rule for the first step is same day purchases. This is different for company. For individual, we check the next 30 days purchases. For company, we look back and check if any shares purchased within the last 9 days before disposal. And third point is also same. The remaining shares are to be considered from pool. So as I told you, matching principle is used to find the cost of shares. Read requirement with me. What cost figure will be used in the calculating the chargeable gain on the disposal of JADE's 25,000 ordinary shares in Silver PLC? Who is going to dispose? JADE's. It's not JADE's PLC. It's not JADE's Limited. It's about the disposal by an individual person. So for shares disposal from an individual person, we have to find the cost of the shares using the matching principle. J sold 25,000 shares in Silver PLC on 13th March 22. Disposal day is 13 March 22. First of all, we will be looking towards any shares purchased on this day. Then we'll be looking forward for next 30 days from the disposal date till 30 days, till next 30 days, if any shares purchased or not, if the data is given or not. So it will become 14th April 22, because from the shares disposal, if we do count next 30 days, so the relevant date will be 13th April 22. J had purchased 6,000 shares in Silver PLC on 18th Feb 13 for 72,000, and thereafter on 24th May 16, Silver PLC made a 144 bonus issue. Means you didn't find any same day purchases, you didn't find any shares in next 30 days. It means the entire shares which are disposed, the 25,000 shares, these shares are to be taken from pool. We know the number of shares which are required from pool, but we don't know about the cost. How we prepare pool working, what to do in the pool working. So first of all, person purchased on 18th Feb 2013 60,000 shares purchased for 72,000. Thereafter on 24th May 16, there is a bonus issue of 1 for 4, means one new share would be given to the person who already has 4 shares. 1 for 4 fraction works one new share for every 4 shares already held. It means on this date, person received 60,000 into 1 upon 4. Person received further 15,000 shares, but as this is a bonus issue, these shares are given free of cost. The total number of shares are becoming 75,000 and total cost will remain same 72,000. And whenever we do work in the pool, the shares to be considered according to the weighted average. So if we take the weighted average cost 72,000 divided by 75,000, so you will get 0.96. Means the whatsoever are the number of shares which are to be considered from pool, these shares will be multiplied at a weighted average cost, and our weighted average cost is calculated as 25,000 into 0.96, 24,000. So that was the requirement, calculate the cost figure. So B is the correct answer. Yes, your answer is also fine. Okay, moving forward, any unclarity in question number 9? If any one of you have any unclarity, any disagreement, you may please raise your question. Osama and rest of the others, please. Okay, do try to attempt this question at your own. I'm waiting for your answers, please. Yes, B is the correct answer for this question. If you remember, in IST, there are basically 2 lifetime transfers. In IST, there are basically 2 lifetime transfers, And these lifetime transfers are termed as potentially exempt transfer and the chargeable lifetime transfer. Potentially exempt transfer means when a person in life transfer any asset to other person, and CLT means when a person transferring an asset in life to a trust. So this PET may become taxable in life, but this PET will remain always exempt in life. This CLT will become taxable in life if value is more than the nil rate band of the transfer year. In this situation, this CLT will become taxable in the year of transfer. But if the value of CLT is less than the nil rate band of the transfer year, then it will remain exempt. So we can say is that for IST lifetime transfers, PET is always exempt, but CLT may become taxable if the value of CLT is more than the nil rate band of the transfer year. If this asset is becoming transferred, then there is a possibility that who would be paying tax. If this is a scenario, then tax would be paid at 20% or 25%. 20% when the trust would be paying taxes, 25% when the person would be paying taxes. But the question is, okay, question number 10 is also bear this discussion in mind. During March 22, an investor made the disposal of shares in unquoted trading companies. Unquoted trading companies shares which disposal could qualify for investors relief. Basically, this discussion is not pertaining to question 10, but this discussion is going to help you out in the next questions. So I'm for the time being erasing it and coming to the actual question which is being asked in question number 10. If you remember, in capital gain taxes, we have multiple type of reliefs. For example, gift holdover relief. For example, business asset disposal relief. For example, holdover relief or rollover relief. And another one is investors relief. There are multiple other reliefs. I'm not going to write the name of all of the reliefs. I can tell you one more, that is insurance relief. There is another relief named as principal private residence relief or exemption. Another one is letting relief. So all of these reliefs are pertaining to the capital gain taxes. But the question is about investors relief. During March 22, an investor made 4 disposals of shares, and these shares are of unquoted trading companies. Examiner is asking which disposal could qualify for investors relief. For investors relief, for this relief, I can tell you few conditions in a summary form. When this investors relief would be available, first thing, the nature of company. The company should be unquoted trading company. Person should subscribe shares from company. Subscribed shares from company. after 6 April 16 and should hold for at least 3 years before disposal. Person should not be employee of the company. Employee or director of the company. So based on these points, now we can start reading the question requirement again, and then we'll decide our answer. Person has made 4 disposals and these shares are of unquoted trading company. Means the first condition is meeting for all of the disposals. Okay. And which disposal will qualify for investor relief? Shares purchased from a shareholder. Shares purchased from a shareholder. For claiming investor relief, the shares should not be purchased from any other person, from any other shareholder. The shares should subscribe from the company through subscription. So due to this thing, option A is incorrect. This disposal of share will not qualify for investors relief, because for claiming investors relief, all of the condition must be met. It's not only 1 or 2 conditions, all of the conditions must be met. Number 2, shares acquired by subscription, okay, during June 18. Shares subscribed after this date, yes, this condition is met. Shares subscribed from company, yes, this condition is also met. Company is of unquoted trading company, yes. We have to check the last 2 conditions. Person is not the director of the company, last condition is also met. Second last, and should hold for at least 3 years before disposal. Person purchased these shares from the company after 6 April 16 on June 18, and from June 18, what is the maximum date if we count 3 years from June 18? June 19, June 20, June 21. So 3 years are meeting till June 21, and person has now disposed the shares in March 22. So this shares disposal will qualify for investors relief. Why not C and D? Let me discuss those as well. Shares purchased from a shareholder, due to this thing, we have crossed this statement. Shares acquired by subscription during August 19. If we start counting 3 years from this date, August 20, August 21, August 22, if person will dispose the shareholding after this date, then these shares will qualify for investors relief. But as a person has made all of the disposals during March 22, so that is the reason option D will not qualify for investors relief. Are you guys okay? Very, very important point from capital gain taxes. Are you guys okay? Got this one? I'm not getting any answers from Salman.
Excuse me, excuse
Yes,
me.
yes, please ask.
Not is clear this point for share acquired subscriptions.
Okay, let me explain you. If you have money in your pocket and you want to purchase shares, you have now 2 options to purchase the shares. You can purchase shares from any other shareholder. For example, I'm the existing shareholder of a company and now I want to dispose of my shareholding. So you can purchase shares. You can purchase shares from me. I'm an individual shareholder. I'm a person. You are purchasing shares from me. So that is a situation 1. Number 2, You are purchasing shares from the company and you are directly subscribing shares from the company. So that is situation 2. For claiming investors relief, these shares should not be purchased from any other person, from any other shareholder. Rather, these shares are purchased from the company through subscription. So if the such shares are purchased from the company and now upon meeting of all of the conditions, if the shares are disposed of, then the person can claim the investor's relief. Is the difference is now clear between the shares purchase?
Okay, clear.
All right.
Okay.
Moving forward, this question is pertaining to the following scenario relates to question number 11 till 15. Okay. J disposed of various assets during the tax year 21-22, and these disposals resulted in chargeable gains of 46,400, qualifying for business asset disposal relief. Okay. Directly the chargeable gains are given, and these gains qualified for business asset disposal relief. If any gains qualified for business asset disposal relief, they will be taxed at lower rate of CDD, which is 10%, regardless of the status of taxpayer. I repeat, if any gains qualified for business asset disposal relief, these gains will be multiplied at a basic rate of CDD regardless of the status of taxpayer. Normally, how we decide the CDD rate? By looking at the taxable income of the person, the status of the taxpayer. If a person is high or additional rate taxpayer, that person would be paying capital gain taxes at high rate. But if a person is a lower, is paying taxes, is paying income taxes at a lower rate, at a basic rate of 20%, then that person will be paying capital gain tax at a lower rate of 10%. But if any gains qualified for business asset disposal relief, regardless of the status of taxpayer, whether he is additional rate, high rate, or basic rate, straightforwardly, the person would be paying the capital gain taxes at 10% on the gains which qualified for business asset disposal relief. And another 123,300 chargeable gains which do not qualify for business asset disposal relief means the taxation of these gains will be according to the status of taxpayer. We cannot decide the rate directly. Rather, we shall be checking the status of taxpayer. Then we will be deciding the tax rate of CDD for these chargeable gains which do not qualify for business asset disposal relief. Okay. None of the gains are residential property gains means 18% or 28%. These rates will not be applicable because none of the gains are residential property gains. J's disposal included the following. Although the gains are directly given, but how these gains are calculated, these gains are based on different 4 transactions. So the J's disposal included the following. These are 4 different transactions. On 19th April 21, J sold 5 hectares of land for 72,000. He had originally purchased 8 hectares of land on 7th June 12 for 68,000. The market value of the unsold 3 hectares of the land as at 19th April 21 on this date is 40,500. This pertaining to the part disposal concept. In the capital gain taxes, we do study a concept named as part disposal. Cost of part sold is to be calculated. On 8 June 21, J sold an antique table. Antique table is a non-wasting asset. And at time of disposing non-wasting asset, there could be any of the 4 situations. What are these 4 situations? If you remember, we'll be checking if the DP and cost both are less than, if the disposal proceed and cost both are less than 6,000, it will remain exempt. If both are more than 6,000, we'll be performing normal calculations. If the disposal proceed is less than 6,000 and cost is more than 6,000, then a deemed disposal proceed is to be considered at 6,000. And if the DP is more than 6,000 and the cost is less than 6,000, in that situation, we will perform two different calculations and lower of will be the capital gain tax. What are these two calculations in this situation for? One of them is normal calculation and the second one is a 5/3 rule. So hopefully you have recalled the relevant areas. So it's an antique table sold for 12,800. The table had been purchased on 2nd May 10 for 1,300. Okay, fine. You can see is that disposal proceed is more than 6,000 and cost is less than 6,000. So basically it leads toward the situation number 4, and from the 4 situation it's a situation number 4, and in situation number 4 we normally do perform two calculations and do consider the lower of the normal calculations and the lower of 5/3 rule. So you have to bear all of these things in mind. Okay, on 19th November 21, Jay made a gift of his entire shareholding of £1 ordinary shares in AMZ PLC to his son. For CDD purposes, son is a connected person, and any shares which are given, which are transferred, which are sold at market value, which are sold at less than market value. So any transactions in between connected persons are always recorded at market value. On the date of the share gift, the shares were quoted at 10.20 to 10.60. The quoted company shares market value is determined using any of the two methods. What are these two methods? Average of ask and bid price, or half up of bid price. I'm just writing the relevant areas to make you recall. The quoted company shares market value is being calculated by using any of these two methods. These are different two methods. Both will be giving you the same answer. Method 1 is average of ask and bid price, or half up of bid price, because in between connected persons, all of the transaction should be recorded at market value. So what is the market value of the shares transferred to Sun? We have to calculate according to the formula. For transaction on 10th May 22, J sold a factory and this disposal result in a chargeable gain. Okay, fine. No further details are given with respect to this factory sold, and this resulted in a chargeable gain. Okay, it's a general statement. I don't know what will be the questions which have been asked. J does not have any taxable income for this tax year. It means J does not have any taxable income means J does not have any taxable income means the basic rate band limit, the basic rate band limit is available. The whole amount is available 37,700, because the 37,700 limit is firstly covered by taxable income, as we did in the last question somewhere over here, I guess. This basic rate band limit is firstly covered by taxable income and differential is available for gains. But over here in this question, J does not have any taxable income means the basic rate band limit is available 37,700. And from this band limit, let me tell you one important point with respect to the band limit coverage. This band limit firstly covered by taxable income, then by gains. In that question, while solving, we just write this point, the gains. But if the gains are divided into the business asset disposal relief gains and the gains which do not qualify for BDR, so if the gains are further categorized, so which gains are to be considered at first priority, or which gains which are to be considered at the second priority? So if this is the case, from the after covering the taxable income, first of all we will be covering the band limit by the gains which qualified for business asset disposal relief, and thereafter we'll be covering the band limit by any gains which are non-business asset disposal relief gains, any gains which do not qualify for business asset disposal relief. So at that time, we just marked it as 2. But now, if the gains are further classified into categories, so after covering the taxable income, BADR gains will cover the band limit, and then non-BADR gains will cover the band limit. So over here in this situation, you will see this band limit is firstly covered by taxable income, but taxable income is not given. Then the gains which qualified for BADR gains, and then we'll be deducting the non-BADR gains. So this is how we shall be covering the band limit. So you have discussed the relevant things while reading the scenario. We have discussed all of the things, and I would be giving you 2 minutes time for solving each question, as you are going to attempt all of these questions at your own. So it's 2 minutes time to attempt this question number 11. Yes, D is the correct answer. Very right. D is correct answer. What is the requirement? What cost figure will have been used in calculating the chargeable gain on the disposal of J's 5 hectares of land? As I told you, it's a concept of the part disposal. Cost of part sold is a requirement. Cost figure of the part sold. So the cost of part sold is being calculated. Market value of the part sold. Market value of the part sold, 5 hectares sold for 72,000. So that is the market value of the part sold divided by market value of the whole asset at time of disposal. So the asset disposed plus the remaining asset. We should add both things. The remaining 3 hectares value at that date is 40,500. So the market value of the part sold divided by market value of the whole asset at that time multiplied with the original cost. Originally, he purchased 8 hectares for 68,000. So if you solve this fraction, you will come to an end that is 43520. So that is the cost of part sold. Basically, the gains have already, Osama. Basically, the question is not about the calculation of the gains, because the gains have already been calculated and directly given in the second line of the question of the scenario. It means if the gains are directly given, so it means you will be having different requirements for each question. As far as question number 11 is concerned, so you can see only the cost is calculated, the cost is required, the cost of the part sold, that which costs have been used in the calculation of the chargeable gains. Although the chargeable gains have already been calculated, but which cost is deducted in that calculation, so we have to tell, and D is the correct option. Next question, please. Scenario is same, but the question is somehow different now. In this question, the chargeable gains, calculate the chargeable gains in respect of the disposal of antique table. As I told you, it's a non-wasting chattel. It's a disposal of the non-wasting asset, and it's pertaining to the situation 4. In situation 4, we have to consider two different things. What are these two different things? Situation 4 gain is basically based on the lower of the normal calculations and a rule named as 5/3 rule. What is normal calculation? Take the disposal proceed, which is in fact 12,800. Deduct the cost element. Cost A is 1,300. Gain amount is calculated as 11,500. Under 5/3 rule, what should we do? 5/3. Disposal proceed, that is a formula, 12,800 minus 6,000. So that is a formula for under 5/3 rule, 5/3. Disposal proceed minus 6,000. 6,000 is given by HMRC. The resulting figure is calculated as 11,133. So 11,133 is the chargeable gain because as we discussed, basically the lower of these two, so the lower gain is becoming 11,133. So A is the correct option. By the way, why we marked it as situation number 4? Situation number 4 is applied when disposal proceed is more than 6,000 and cost is less than 6,000. So that is under situation number 4. Then the gain would be decided according to the lower of. Are you guys okay with this thing? Next question. What market value figure will have been used in calculating the chargeable gains of J's gift of AMZ PLC shares? As I told you, AMZ PLC shares are given to Sun, and Sun is a corrected person, and the shares are of quoted company. So quoted company shares can be, market value of the quoted company shares can be determined at both values divided by 2. So you will end up with the value of 10.42. So basically we have used average. It's not basically if we are using average. So let me write it separately. As I told you, we have two options for quoted company shares valuation. We have two options. Number one is average of ask and bid price. So 10.420 plus 10.64 divided by 2. So you will get 10.42. Second method I told you over here. So that is basically half up of bid price. What exactly do you mean by this half up of bid price? Take the bid price. Bid price is always be a lower price plus the difference between these two values. The difference in between 10.64, the difference in between these two values is, can you please tell me the difference? .44, half up of means take the difference and divide it by 2. So it's becoming 0.22. 0.22 is then added to 10.20. So it will give you 10.42. And one more important point, and if unquoted company shares are given in question, so normally the unquoted company shares price is also given in the question. But if the quoted company shares are given in the question, then for quoted company shares we can use either of these two methods, the value will remain same. So correct option is option C. Question 12, correct answer is A. The lower of between these two is 11333 as compared to 11500. And question number 13, correct option is C. Moving forward, requirement: during what period must reinvestment take place if J wishes to claim rollover relief in respect of chargeable gain arising on the disposal of factory? Over here, it's about selling a factory. Factory is a business asset. And if after the disposal of a business asset, person acquire another business asset, then for claiming relief purposes, that person must reinvest the amount in a qualifying reinvestment time period. I repeat, as a person is disposing a factory is a business asset. If after the disposal of a business asset, if person want a relief, then that person is required to reinvest that money in a qualifying reinvestment time period. And the question is exactly the same: during what period must reinvestment take place? So if you remember, the qualifying reinvestment time period in total is 48 months. I repeat, the qualifying reinvestment time period in total is 48 months, but that 48 months to be checked if an asset is purchased within the last 12 months before disposal, and if an asset is purchased within the next 36 months after disposal. So what is the disposal date? 10th March 22. We'll be looking back 12 months if an asset is purchased within the last 12 months before disposal, or if an asset purchased after disposal date within the next 36 months. So basically, what is the total qualifying reinvestment time period if we go back 12 months? So the relevant date will be 10th March 21. And if you move forward 36 months, then the relevant date will be 10th March 25. So you can see these dates are there in option number, no, in it's not B. Basically, we should not count directly 48 months from the disposal time. The actual rule I have written in front of you. So we are finding these dates in option number C, I guess. It's not B. The correct option is C. Qualifying reinvestment time period is like 48 months in total, but these 48 months are to be checked in this manner: if an asset purchased within the last 12 months before disposal, and if an asset is purchased within next 36 months after disposal, then that disposal can can meet the definition of qualifying reinvestment time period. Are you guys okay? I'm not getting your answers in today's session.
Excuse me.
Yes, please.
I want to know why the C choice is right.
Sorry, I'm not getting your voice. Hello?
Choice C is right. Why? I want to know about this choice.
Because we do study a concept named as qualifying reinvestment time period. Qualifying reinvestment time period is in total 48 months, but these 48 months How to check these 48 months? From the disposal date, do consider the last 12 months and do consider the next 36 months after disposal. So if an asset purchased from this date till this time, then we can say that it's equal to 48 months, and basically it's meeting the definition of qualifying reinvestment time period. So these 48 months should not be counted from the disposal date. We should not only looking forward.
Okay, right.
Let's say you have disposed an asset in today's date. Here is a gain. Now you want any relief. Can you claim any relief? Yes, there is a choice available. You will be looking back. If an asset is purchased within the last 12 months before today's disposal, then against that purchase of asset which you have already purchased, you can make the claim relief. Is it clear now?
Clear now.
Okay, good enough.
Okay.
Next question is, what is the capital gain tax liability for this tax year? As I told you, please do not ignore this discussion point which I marked here. When the gains are categorized into BADR and non-BADR gains, then after covering the taxable income in the band, how the gains are to be prioritized, I have written. Means, first of all, the basic rate band limit will be covered by taxable income, then the gains qualified for BADR, and then by the gains which do not qualify for BADR. And it's a challenging question. You have to calculate the capital gain tax liability in question number 15. Although the gains amount have already given in front of you, but you have to work smartly, you have to think, you have to plan your answer, and it's a challenging question. I have allowed time to you guys to attempt this question. So that's why it's mute. Any answers from your side? Basic rate band limit is 37,700. First of all, it will be covered by taxable income, but taxable income is not there in question. Then it will be covered by capital gains, but the gains which are business asset disposal relief. Business asset disposal relief gains amount 46,400 means they have covered the entire band amount. They are not linked with the band limit. Any gains which qualified for BDR, they will be taxed at 10%. 4640 is the capital gain taxes. Although they would be covering the band limit, but the any gains which qualified for business asset disposal relief, they will directly be multiplied at 10%. Then no space is available for covering the chargeable gains which are non-BDR gains. 123,300 annual exemption is still available. So from this value, we should deduct annual exemption of 12,300 because these are the chargeable gains. After this deduction, we'll be getting the taxable gains of 110,000, and these gains will then multiplied with the 20% value. Why? Because basic rate band limit has already covered by BADR gains. So the 111,000, it's basically 111,000 into 20%, that is giving you 222,000. And if we add both values, 222,000 and 4640, so the total capital gain tax liability will be 26,840. B is the correct answer. Is this thing clear? All right. Next question is very much important because I know all of you would be making some mistake over here, but this question is pertaining to companies, and for companies, for losses adjustment, we do study a concept, because these gains directly qualified for 46,400. These gains qualified for business asset disposal relief. So business asset disposal relief is a relief. If any gains do qualify for this relief, they will directly be taxed at 10% regardless of the status of taxpayer. Irrespective of the status of taxpayer, if any gains qualified for business asset disposal relief, they are directly going to multiply at 10%. They are not linked with the taxable income or the status of taxpayer. So that is the reason we do consider the BADR gains always at 10%. Same case with the investors relief. If any gains qualified for investors relief, they will be taxed at 10% regardless of the taxable income or the status of taxpayer. Is this clear? And also, we have not deducted the annual exemption from 46 to 400. Although the annual exemption was available, why we didn't deduct annual exemption from here? Because according to tax planning, these gains have already been taxed at a lower rate. So what is the point to deduct annual exemption from here? Dorcas, is this thing clear now? So basically, the gains which are under BDR relief, they will be taxed at 10%. They have already a lower rate of tax, so there is no point to deduct the annual exemption from the BDR gains. So always try to deduct the annual exemption from the gains which have a high rate of tax. So that is the reason we deducted the annual exemption from the gains which are non-BADR gains. Is my voice clear now?
Yes, that's great. Thank you.
Welcome. Moving forward, and this question is pertaining to the corporation taxes. And for companies, we do study two different concepts. Companies can adjust their losses with each other. So that is under the group loss group. And second, for capital gains and losses, there is another different separate concept named as capital gain group. For group loss group, direct and indirect shareholding condition, it should be more than 75%. And for capital gain group purposes, direct shareholding should be of more than 75% and indirect shareholding should be of more than 50%. So any companies which are in the group loss group, they can transfer their losses with each other except of capital loss, because for capital loss adjustment, another concept is there named as group loss group, capital gain group. So any companies which are under this group, they can transfer capital gains or losses to other group companies. The shareholding condition for both is different. The companies which are in group loss group, they can transfer their losses. Which losses? Other than capital losses, any type of loss, any unrelieved loss basically. So any companies which are under group loss group, they can transfer their losses to each other. But according to the definition of the group loss group, which companies are there in the group loss group? Any companies wherein the shareholding is direct or indirect shareholding is more than 75%. And which companies will be there in the capital gain group? Where the direct shareholding is of more than 75 and indirect shareholding is of more than 50%. Keeping these things in mind, read the requirement carefully along with the BAT limited, which companies form a capital gain group. So the requirement is about the second thing. I have marked the shareholding requirement. So keep this requirement in mind, read it carefully, read it again, along with the BAT limited, which companies form a capital gain group or chargeable gain group with X limited. It means with X limited, B is already there, but the question is about the remaining companies. X limited owns 90% of B, BAT limited. Okay, BAT limited in turn owns 70% of Club Limited. B further owns 70% of C Limited. Okay. C Limited owns 100% of, who is owning? C owns 100% of Dance Limited and 80% of E Limited. So here is a group structure. A requirement is, along with BAT Limited, which companies form a capital gain group according to this shareholding, which companies will be there in the capital gain group. What is your answer? Correct option is D. Now you will think how. A and B are already in the capital gain group. The requirement is not about A and B. Along with BAT Limited, A and B are already there in the capital gain group. Along with BAT Limited, which companies form a chargeable gain group? Which other companies will form chargeable gain group? So what is that holding condition? Holding condition is the direct shareholding should be of more than 75. If we look about B and C, if we look into B and C only, so is this meeting the first thing? Is it meeting the condition for direct shareholding or not? Is the shareholding of B into C is more than 75 or less than 75? Do forget about D and E. First of all, do check the first condition. I'm talking about this. Is this condition is meeting in between B and C? So this shareholding is less than, direct shareholding is less than 75. So no need to check the indirect shareholding. First of all, do check the first condition. Is the direct shareholding condition is meeting? Answer is no. So then do forget for further things, because the basic condition is missed out. The direct shareholding condition is less than 75. How we can move forward for checking the indirect shareholding? So no other company will be the part of the capital gain group. Is this thing clear? Yes, Osama, are you clear now? So basically that is the reason no other company will be the part of the
Clear
capital
now.
gain group. Sorry.
Clear now.
Okay. Next question, please. Again, this question is pertaining to the corporation taxes, and we do study a concept with respect to, as I marked over here, group loss group. Means any companies which are in the group loss group, they can transfer their loss with each other. They can transfer their loss to each other, but there is also condition which is corresponding time period. Corresponding time period means similar time period. Although the group loss group companies are allowed to transfer their loss to other group companies, but this loss adjustment should be according to a corresponding period, means the similar time period. Maybe there are multiple companies in the same group, but all of the companies are preparing accounts for the different accounting end dates. So how they can transfer their loss? They can transfer the loss for that time only, which is a common time period, which is a corresponding time period, which is a similar time period between the companies. So keeping this thing in mind, try to attempt this question number 17. My dears, I would suggest to revisit your answer, please. It's not D. Furthermore, after checking the corresponding time, then we will check a thing that whether the profits are lower or the losses are lower for the corresponding time period. So according to that, we can adjust the losses with the group companies. Look, how much B's limited trading loss can Green Limited claim against its taxable profits for the year ended March 22? If we talk about Green, yes, Ikra B is correct answer. If we talk about Green Limited, so Green Limited year end date is given as Green Limited claim against taxable profits of Green Limited. Green Limited year end date is given as 31st March 22. If that is a year end date, it means the year started on 1st April 21 and after 12 months time period, it is ending on 31st March 22. Green Limited owns 100% of the ordinary shares of Blue. Shareholding condition is met for the group loss group companies. For the year ended 31st March 22, Green Limited has taxable profits of 132,000. This company 12 months profit amount is 132,000. Okay, fine. For the 9-month period ended 31st December 21, Blue Limited has a trading loss of 84,000. If we talk about Blue, it's basically a year end date, it's basically a period end date, and period is ending on 31st December 21. So if a period is ending on 31st December 21, it means it's a period of 9 months. If it is a period of 9 months, it means when it is started on 1st April 21. So you can see is that the 9 months loss is a value of 84,000. So Blue Limited and Green Limited, both companies are in the group loss group. It means Blue Limited can transfer its loss to Green Limited, but according to a corresponding time period. If losses are given for 9 months, then we have also to calculate the profits for the 9 months. If 132,000 is a profit for 12 months, and if we do find the profit for 9 months, so it's becoming 99,000. Then we'll decide according to the lower of 9 months loss is 84,000, whereas 9 months profits amount is 99,000. So based on the lower of thing, lower of amount is 84,000. So B is the correct answer. For example, if it is becoming as 75,000, then our answer will be 75,000. Max loss that can be surrendered with the group company will be the lower of always. Are you guys okay? Next question is, which of the following cannot be surrendered as part of current year group relief claim? From these two definitions, it is crystal clear which thing cannot be claimed using the group relief claim. Unrelief qualifying charitable donations can be transferred with group companies trading losses, unrelief business loss. Under this group relief claim is we are talking about group loss group. In the group loss group, all of the things can be adjusted except of capital losses, because capital losses treatment is based on a different scenario that is under the capital gain group. So capital losses can never ever be adjusted under group loss group companies. Capital losses cannot be adjusted with the group loss group companies because Capital losses are adjusted under the capital gain group companies. Capital gain group companies is the adjustment for capital losses, whereas group loss group is the adjustment for other losses. So all of the things can be adjusted under group loss group, but capital losses cannot be surrendered as a part of group loss group. Is this thing clear? It's supposed to be here. It's a format difference. What is the maximum amount of group relief which can be claimed by S Limited for the year ended 31st March 22? For example, let me guide you what is claimant company, what is surrender company. As company B has a loss and this company wants to transfer its loss to other company. So company B in this situation would be considered as a surrendered company. And company G, the green limited, would be considered as claimant company. So the company which basically adjusting the loss of other company, that company is termed as claimant company, and the company which has a loss and transferring its loss to other group companies, so that is basically termed as surrendered company. So the requirement is here with respect to the S Limited, and what is the maximum amount of group relief which can be claimed by S Limited means S has profit, S will be claiming the losses of other companies. How much loss can be claimed by S company? Because any company who actually adjusts the loss of the other company, so that company is claimant company. So this question is with respect to the claimant company. First of all, we have to check the S own results. S own results include trading loss of 8,400, property business income, loan interest, capital losses, qualifying charitable donations. So if we rewrite it, trading loss, okay, current year positive property income is 55,200, it's 2,900 of positive income. I'm not taking the capital losses because capital losses are to be treated under the capital gain group. However, we are talking about the group loss group companies. So not taking the amount of capital losses and qualifying charitable donation is 2,000. It's all about S Limited. S Limited, first of all, will be adjusting all of its own things. After all these adjustment, 47,700 is calculated, that the amount of positive income is still available, and to this extent other companies can transfer the loss amount to this extent, and the S company can max adjust the loss of the other companies to this extent, because after its all own adjustment, the maximum amount which is still available by S Limited is 47,700. So C is the correct answer. Are you guys okay? Anything to ask? If you are unclear with anything, you may please raise your voice, raise your concern. I'm here to respond to you. Okay. Question 20. By what date must Cat Limited and Mouse Limited make an election if they want their respective capital loss and chargeable gains to be matched? This election is pertaining to, for example, there are two companies in the same capital gain group. Capital gain group is a group for the capital losses and the capital gains adjustment. For example, if a company is disposing an asset and have capital loss, and other company in the capital gain group is disposing an asset and have other capital gain, so these companies can adjust the losses and gains with each other, but there is an election involved, and this election is basically the time gap is 2 years, and the 2 years time should be counted from the end of accounting period in which assets sold. I repeat the situation, then you can let me repeat the scenario, let me repeat the concept, then you can apply the same concept in this question and you can consider your answer. If there are two companies in the capital gain group and the capital gain group is, for example, there is company A, there is company B, these two companies are in the capital gain group, and company A disposed an asset on which there is capital loss, company B disposed an asset there is on capital gain. As these companies are the part and parcel of capital gain group, it means the capital losses and capital gains are to be adjusted with each other. But this adjustment, this selection should be made within 2 years from the end of the accounting period in which the asset is sold. So you can see that CAT Limited owns 100% of the ordinary shares of Mouse Limited, means they are the part of the capital gain group. Both companies prepare account to 31st December. The corresponding time period is also same. On 10th June 21, Mouse Limited sold an office building. Mouse Limited sold an office building, and this resulted in a chargeable gain. On 20th November 21, C Limited sold a factory, and this resulted in a capital loss. Both of the transactions are happening in the same year end, 31st December 21. So one of the company has chargeable gains, other company has capital loss. So these companies can elect to adjust their capital losses and gains with each other 2 years from the end of accounting date. These transactions are being held in 2021. So 2021 will end on 31st December 21. From this time, we have to count 2 years further. So the relevant date 31st December 23. So 31st December 23, A is the correct option. I don't know, Ikra, how you marked. These 2 years should not be counted from the sale date. Over here, we have written this point as 2 years from the end of the accounting period. From the end of the accounting period, do not consider the disposal date. First of all, from the disposal date, do consider the year-end date, and from year-end date, then count further 2 years time period.
Excuse me.
Yes, please.
Why choice A is correct? Not C.
Because over here, these 2 years time period, it is not written as 2 years time period from the disposal date. No, the 2 years time should start from the end of the accounting period in which the asset is sold. First of all, we have to end that accounting period in which the asset is sold. Both assets are sold in 2021. One of the assets is sold in June 21, another sold on November 21. So what is the accounting end date for this year? So what is the accounting end date for this year? That is 31st December 21. From 31st December 21, we will be counting 2 years from the accounting end date, not from the disposal date. So that is the reason our option is 31st December 23.
Okay, clear now.
Omar, are you clear now?
Clear.
Okay, Osama. Omar, what about you? Okay. The next question is, ignoring the residential nil rate band, how much nil rate band is available against Wong's estate? Okay. It's pertaining to IST. Wong died on 4th Jan 22 when his wife Wing died on 3rd August 17. Her entire estate of 200,000 was left to Wong. However, Wing, her wife, had made a gift of 100,000 to her daughter on 2nd May 17. The figure is after deducting the available exemptions. Okay. The nil rate band for the tax year 17-18 is 325,000. Ignoring the residential nil rate band, how much nil rate band is available against Wong's estate? In IST, we do study that the residential nil rate band and also the normal nil rate band both can be transferred to spouses. It means over here we have to consider Wong's own nil rate band plus Wong's wife nil rate band. So the total nil rate band would be available to Wong, and that nil rate band can be deducted from the Wong's estate. Can you please calculate? Wong's own nil rate band is available for if he died on 4th Jan 22. 4th Jan 22 is in the fiscal year 21-22. So that is 325,000 plus Wong's wife's nil rate band. His wife died on in 2017. If we look at wife died on 2017, and in the same year on 2nd May 17, she gifted 100,000 to her daughter. It means this asset will become taxable at time of her death. If we start following on 2nd May 17, she did a PAT of 100,000 to her daughter. Okay. Then at time of death day is after May, on 3rd August 17 she died. We'll look back, and if an asset is being transferred within the last 7 years, so that asset will become taxable at time of death. If this 100,000 is taxable at time of death, it will be covering the nil rate band amount of death year, that is 1718. This asset is covered by nil rate band of the death year. So okay, fine. Nil asset is becoming taxable, and the remaining estate of 200,000 transferred to Wong. It means if we talk about wife total nil rate band was 325,000, of which one of the asset became taxable due to 7-year rule. So what is the remaining nil rate band available to the extent of 225,000? The difference, and this 225,000 can be transferred to Wong. So the difference, so the addition of 325 and 225 is 550,000, and this 550,000 nil rate band can be used by Wong at time of his death. His own and his wife's unused nil rate band can be used by Wong. Are you guys okay? Is this in clear? Next question is also pertaining to IST. What is the value of PAT made on 7 September 21 by Win to his daughter? On 22nd May 20, W made a gift of 4,400 to son. This date is in the fiscal year 2021. He has gifted an asset to son. It is PAT for IST purposes. Then thereafter on 2nd September 21, which is in the fiscal year 21-22, he made a gift of 7,200 to his daughter. We have to calculate the PAT value of this date when he transferred an asset to daughter. If you remember, on this date, what PAT he transferred to daughter with the value of 7,200? In IST, we do consider the annual exemption of 21-22 because this date is falling in this fiscal year. Annual exemption for each year is separately available as 3,000. Furthermore, we can further deduct the annual exemption of previous year if available, but he has already made a gift to his son in the previous year. So this year annual exemption is not available. After deducting this, net PAT value is calculated as 4,200. So correct option is D. No, it's not B. Daniel, where from you calculated B? No, you cannot take both because so what's the reason for giving this data? As he has already made a transfer in the previous year to son, so it means he has used the annual exemption of 2021. So you cannot use. Few minutes back, I told you a concept that CLT may become taxable in life, and when a CLT, why a CLT is becoming taxable in life? What is the reason? I also told you the reason. If the value of CLT is more than the nil rate band of the transfer year, then the excess amount will become taxable, and the excess amount is taxable maybe at 20%, maybe at 25%. But when to use 20%? When the tax is calculated by trust, and when to use 25% when the tax is calculated and paid by person himself. So here the question is requirement is pertaining to the same concept. Can you please try and can you please calculate? Okay, what is the requirement? What is A's lifetime IST in respect of the gift of 440 to trust? Whenever there is a gift to trust, so that is CLT. What is A's lifetime IST? It means this asset value CLT in life becomes taxable when CLT is more than the nil rate band of that year. So on 12th June 21 in the fiscal year 21-22, A made a gift of 440,000, the value of 440,000. This figure is after deducting available exemption, so directly considered here. And this year nil rate band is 325,000. How we know? Because 21-22 nil rate band is 325,000. So excess is becoming 115,000. So that is the reason this asset will become taxable at time of death. A will pay IST arising on the gift. That's very important statement here. When the person would be paying any IST, so the calculation should be made at 25%. If it is written as trust will pay the tax, then it will become 20%, but due to this thing, we are multiplying with 25%, so 28750 is calculated. Correct option is D. Next question, can you please specify the requirement and can you please solve? Perfectly answered, Daniel. Your answer is fine. Annual exemption is always available, Umar. If a person is making any transfer in life, so annual exemption for each year is available 3,000. It's not available for each transfer separately. So the requirement is on 20th November 21, A made a gift to trust and this resulted in IST of 46,000. As we did calculate IST in previous question, but for this question, the lifetime IST is 46,000. What is the due date for paying IST? First of all, take the month and date, 30th November 21, and then do count the 6 months. So which is 31st May 22. C is the correct option. All of the answers are fine. 31st May 22. What is the potential IST saving if we used some of her asset to purchase main residence of 340 prior to death? It's all about the tax potential IST saving, means the IST which could be saved if the person purchased main residence for 340 prior to her death. Although he has not purchased, although the current scenario is different, but what could be the potential IST saving if he purchased a main residence of 340,000 prior to death? We know one thing, that there is a nil rate band available pertaining to the main residence. When there is principal private residence is there in state, and if that transferred to direct descendants, then apart from normal nil rate band, the person can also claim the residential nil rate band as well. So this question is purely pertaining to that residential nil rate band and the tax saving. V has an estate valued at 700,000, but she does not currently own a main residence. Under the terms of her will, V's estate is left to children. Children and grandchildren are categorized as direct descendant. V's husband died on 26 May 17 and all of his estate left to Violet. It means the V's husband died and transferred the entire estate to his wife. It means his nil rate band is available and can be transferred to wife at time of her death. But we are not talking about over normal nil rate band, whereas we are talking about residential nil rate band. Although currently there is no main residence is involved is included in state, but that is a requirement. If there is main residence, what will happen then? It means a residential nil rate band can be claimed on and spouse. And for the fiscal year 21-22, residential nil rate band value is 175. The total nil rate band value would be available 350,000, but IST rate is 40%. If you are multiplying 350,000 into 40%, so that is wrong calculation. Why? Because its question examiner is asking about potential IST saving if the person purchased main residence for 340,000. It means although the total residential nil rate band will be available 350, but if the value of the residential property is less than the available nil rate band, so we cannot calculate the tax saving by using the total amount of the residential nil rate band. Rather, we shall be calculating the IST saving if this amount is added. If there is main residence in the state, then that residence value can be covered by the residential nil rate band from the 350,000 value. It means there will be a potential tax saving of 136,000. So B is the correct option. If there is a main residence is included in property in state, it means in that situation there would have been a total residential rate band available to the extent of 350,000, and if there is a property of 340,000 is included in state, so there could be a potential tax saving of 136,000. Some of previous question answer is C, and question 25 correct option is B. We have attempted 25 questions so far, and I'm keeping till here. There are 20 more questions are there in the same file, which I would be sharing with you guys tomorrow, and you have to solve all those questions at your own. Once you're done with the calculations of the next questions, then you may share your answers with me at, let me write my number. Maybe a few of you already have my number. In case if you don't have, please, you may save. +92 is a country code, 322 is the SIM code, and 3787312 is my number. So I would be sharing this file tomorrow morning along with the video lectures. So it's my request to attempt the remaining questions at your own. And apart from this file and the video recording, I would also be sharing other resources with you guys. And for surely these are going to help you for preparing for your exam. So 92322378731 is my contact number. You may get in touch and you may ask the answers, the explanatory answers for the remaining questions. But my suggestion is to attempt the remaining questions at your own first, then do ask for the answers. If you have any question, query, and clarity with respect to the today's session, you may please ask. And if you are okay, we can conclude this one. But you are allowed to ask questions. I'm here to respond. Don't worry with this thing. Do attempt max question as much as you can. So practice can take you to pass your exam, not any other thing. So Umar, it's my advice to keep revising the key dates. For example, the self-assessments, tax return dates for individual, for companies, for any area which is there in the TX, and try to attempt like 3 to 4 questions a day on the CB practice platform. So because in real exam you would be facing the CB questions, so it's my advice to attempt more and more questions using CB platform. Yes, I would be sharing all of the files, Ikra, don't worry. Just send me a text. I would be in response. I would be sharing all of this stuff. Don't worry. Any other thing to ask, my dears? I don't have the video of the remaining MCQs which are in this file, but I have the explanatory answers. Don't worry. I will be giving those as well, Umar. You're welcome, my dear Daniel. And My prayers, my best wishes are with you guys. Do give your best, and inshallah, you will get your exam pass. In case of any help, you may text, and good luck always. Take care, stay blessed. Bye, and Allah Hafiz. Thank you for your time. Thank you for joining this session. Take care.